Silver just broke through $100 per ounce for the first time in modern trading history. And while every financial news outlet is busy celebrating this milestone, I'm willing to bet that not a single one of them is telling you the real story behind this move. Because this is not just about a number on a screen. This is about a crisis that has been building for 5 straight years. And it is about to reach a breaking point that could reshape how we think about money, industry, and wealth itself. Let me show you exactly what I mean. On January 23rd, 2026, silver futures hit an intraday high of $103.53 before settling at $103.26. That represents a gain of over 46% just this year alone. Compare that to gold, which is up only 15%, or the S&P 500, which has barely moved 1%. Silver is not just outperforming, it is absolutely destroying every other major asset class. But here is what nobody is talking about. This rally is not happening because of speculation. It is not happening because of some social media pump. It is happening because of a structural supply deficit that has been draining the world's silver reserves for half a decade, and there is literally no way to fix it in time. Let me connect the dots for you. Since 2021, the silver market has been running a deficit every single year. Not 1 year, not 2 years. 5 consecutive years of demand exceeding supply. And according to the Silver Institute, the cumulative shortage during this period has reached 820 million ounces. Think about that number for a moment. 820 million ounces of silver that was consumed but never replaced. That silver is gone. It is sitting inside solar panels. It is embedded in electric vehicles. It is wired into 5G base stations and AI data centers. And unlike gold, which gets recycled and reused, most of that industrial silver is dispersed into products in such small quantities that recovering it is economically impossible. Now let me tell you why this deficit is not going away anytime soon. Global silver supply has actually declined from 1.07 billion ounces in 2010 to roughly 1.03 billion ounces in 2024. That is a decrease in production over 14 years, while demand has been exploding in the opposite direction. In 2024, global demand reached an estimated 1.2 billion ounces. That creates another deficit somewhere between 160 and 200 million ounces for this year alone. And here is the part that should make you sit up and pay attention. Silver mine supply has fallen by 7% since 2016, and there are no major new projects coming online fast enough to close this gap. The mining industry is facing higher extraction costs, stricter environmental regulations, and permitting timelines that stretch out for years. Even if silver prices doubled from here, it would take 5 to 7 years before significant new supply could enter the market. The silver is still in the ground, and it is going to stay there for a long time. Now let me explain why industrial demand is the key to understanding this entire situation. Silver is not just a precious metal anymore. It has become arguably the most critical industrial commodity on the planet. And that transformation is what makes this rally fundamentally different from anything we have seen before. Solar panel production alone consumes approximately 100 million ounces of silver every single year. The silver paste that forms the conductive pathways in crystalline silicon cells cannot be substituted with any other material, because silver has the highest electrical conductivity of any element on the periodic table. There is literally nothing else that works as well. And with global renewable energy commitments accelerating, solar capacity additions are expected to double within 5 years. That means solar demand for silver could reach 200 million ounces annually by 2030. Electric vehicles are another massive demand driver that most analysts are underestimating. A modern electric vehicle contains between 25 and 50 grams of silver, compared to only 15 to 28 grams in a conventional gasoline car. That is nearly double the silver intensity. And when you multiply that by hundreds of millions of vehicles being produced globally, you start to understand why the auto industry alone could consume an additional 50 to 100 million ounces per year. But here is what really keeps me up at night. 5G infrastructure is rolling out across the world right now, and it requires silver-based alloys and coatings for base station antennas, power amplifiers, and switching components. Industry estimates suggest 5G deployment could consume 45 million ounces annually once fully implemented. And we are just getting started. AI data centers are the wild card that almost nobody is accounting for. These facilities require massive amounts of power, and many of them are being paired with solar installations to meet their energy needs. A single 500 megawatt solar installation requires approximately 300 metric tons of silver. As artificial intelligence transforms every industry, the demand for data center capacity is growing exponentially, and every new facility needs silver to function. Now let me tell you about the physical market, because this is where things get really interesting. The technical indicators are showing something unprecedented. Silver has maintained overbought conditions across multiple timeframes for 49 consecutive trading days. 49 days. That has never happened before in the history of electronic silver trading. The relative strength index, stochastics, Bollinger Bands all of them are screaming that silver should be correcting. But it is not. And the reason it is not correcting is because the buying pressure from industrial users and institutional investors is so overwhelming that it has completely broken traditional technical patterns. Market profile analysis reveals robust accumulation patterns with volume concentration occurring at progressively higher price levels. That is a characteristic of genuine breakout scenarios, not speculative bubbles. When you see this kind of volume confirmation, it tells you that serious money is moving in and they are not planning to leave anytime soon. The gold to silver ratio has collapsed to 48.3 to 1. That is a 14-year low. Historically, the ratio has swung between extremes of 100 to 1 on the high end down to 31 to 1 at previous silver peaks. If we simply return to the average ratio of around 60 to 1, silver would already be considered fairly valued relative to gold. But if we approach the historical lows seen during major silver bull markets, we could see the ratio drop to 40 to 1 or even lower. At today's gold prices, that would imply silver prices significantly higher than current levels. Now, let me address the risks, because I am not going to pretend that everything is perfect. Silver has historically experienced devastating corrections after parabolic advances. After the 1980 peak, silver crashed 88%. After the 2011 peak of $49.80, it fell 73% over 4 years. These are not small pullbacks. These are wealth-destroying collapses that wiped out investors who bought at the top. But here's the difference this time. In 1980, the Hunt brothers were using leverage and paper contracts to try to corner the market. When margin requirements were raised, they could not meet the margin calls and were forced to liquidate. Today's rally is being driven by genuine industrial demand and institutional accumulation of physical metal. You cannot raise margin requirements on a solar panel manufacturer who needs silver to build their products. You cannot force a central bank to sell physical silver they hold outright. The fundamentals have changed. The demand is not optional, and the supply cannot respond fast enough to meet it. Now let me tell you what I think happens next. If current trends continue, silver inventories will keep declining as industrial consumption accelerates. Exchange-registered stocks are down nearly 70% since 2020. London Bullion Market Association vaults have lost around 40% of their holdings. Shanghai inventories are at their lowest level in a decade. At current consumption rates, some industrial regions have barely 30 to 45 days of accessible silver reserves. That is not a comfortable buffer. That is a crisis waiting to happen. Bank analysts are projecting price targets that would have seemed insane just 2 years ago. Some are calling for $135 to $239 per ounce. And when you adjust the 1980 high of $49.45 for inflation, silver should theoretically be trading around $194 to $200 per ounce today. At $103, we may not even be at the halfway point. Here's what I think you need to understand. We are witnessing a fundamental restructuring of the commodities market. Silver's dual role as both a monetary hedge and an industrial necessity has created a perfect storm that cannot be easily resolved. The supply deficit is not temporary. The industrial demand is not optional. And the monetary conditions that favor precious metals are not going away as long as central banks continue to debase their currencies. I am not a financial advisor, and this is not financial advice. I cannot tell you what to do with your money, but I can tell you what I see. I see 5 consecutive years of deficits. I see 820 million ounces of cumulative shortage. I see industrial demand that is growing faster than anyone predicted. And I see a price that has already tripled in the past year, with analysts calling for it to triple again. The forces driving this market are too powerful to ignore. The question is not whether silver will continue to rise. The question is whether you understand what is happening before it is too late. That is all I have for today. Thank you for watching. Make sure to subscribe and hit that notification bell so you do not miss my next video, where I will be breaking down the specific mining companies and investment vehicles best positioned to benefit from this historic silver rally. Until then, stay informed, stay prepared, and remember, in a world of paper promises and unlimited money printing, physical assets are becoming more valuable by the day. I will see you in the next one.